Hey everybody, how are we doing? Welcome back. Let's go into the Q&A area, please, guys, and let me know that you can hear me okay. There we go. Okay, now things are coming through. Seems like there's a bit of a delay. Okay, good. Australia, US, London, Europe. We're good. Cool. Right, guys, before we get started, what do people think of the markets at the moment? Let me get a sense of what's going on out there. Are we bullish, bearish, neutral? Just type in what your view is on the market at the moment. Can always rely on our group for humor. Okay, I can tell you now, guys, 75–80%, I reckon, of the responses here are bullish. Yeah, so it's either bullish or neutral to bullish, or small bullish, people are saying. Very few bears. So this is exactly why I've chosen this topic today. Because as we always beat the drum about long-short portfolio management, even when you're bullish, and we're in a bull market, no doubt about it, okay? You need shorts in your portfolio. So if you were to get carried away with your bullish outlook and you leaned too far one way, bullish, and you had too many positions on the long side and the market had a drawdown, you get caught out, right? So you have to have shorts in your portfolio, even if you are bullish. So I'm going to share the presentation. Let me know if you can see it. So you should be able to see that now on the screen. Okay. Right, so the whole point of this is basically just to feed back to you guys, because I've been speaking to my Thailand mentoring program guys now for 10 weeks to feed back to you guys, help you out a little bit with some short ideas. So what people are actually shorting on my Thailand mentoring program. So first of all, let's have a look at the results so far, week 10. So top of the leaderboard in 10 weeks, Parik from Ireland. He's up 31 and a bit %, outperforming all major indices by a large amount. And pretty much, well, everyone's making money, apart from the one guy at the bottom, who's had a bit of difficulty understanding what we do. But he should, if he does what I've asked him to do this week, going into the July expiry, he should actually manage to get himself up into positive territory, right? And then there's a couple of slight underperformers against Nasdaq, which is pretty obvious in this market. I mean, the Nasdaq performance has been outstanding, right? The question is as always, we're long-short portfolio managers. Like, we want to be outperforming the market when it goes up, but obviously making money when the market goes down. So if Nasdaq was to have a 10% drawdown, for example, I'd expect these guys and yourselves to make money, right? So that's where, that's where the edge in long-short portfolio management comes in. So what we're looking at here is a 10-week snapshot photograph of when the market has gone up during that time. if we looked over a longer period of time, what you'd want to see is people making money when the market goes up and when the market goes down as well. Okay. But the total here is pretty good. Like as a group, up 14.5%, outperforming all the major indices. Yeah. During that time period. So only slightly outperforming, the NASDAQ indices. So the guys overall have done pretty good. What you got to remember is as well, is, all these guys are brand new traders, right? So you wouldn't expect them to be making money like this quick. So yeah, I'm pretty pleased with that. So, I picked, most of the main shorts. It's not every single short that everyone's got on in the group, but the main shorts that the group that I'm mentoring at the moment have got. Okay. So we've got an alphabetical list here. So I don't mind you taking a screenshot of that, take a photo on your phone, whatever you want to do. This should give you food for thought when looking at these ideas, and if you're researching them yourself. Okay. So we've got Align, Bumble, Coinbase, CRM, Salesforce, DE, DLT, Dollar Tree, Expedia, EXPE, FND, Floor & Decor, Lulu, mRNA, Moderna, Tesla. Okay. And obviously Tesla's had a big move to the upside, but guys have been wrong on that, but it's still worth looking at. Okay. The ones that we're actually going to look at are Lulu, Moderna, and Bumble. Okay. So let's take a look at them. The other ones you're going to have to do research on them yourself. Okay. I can't go through every single one and then you just copy trade. Do your own work on these. Okay. And they're all different types of shorts, right? So let's talk about Lulu first. Okay. So your little table on the left-hand side there. Everything that's in gray is already reported. Everything that's in white is expectations. And it's a pretty obvious trend when you look at revenue growth and EPS growth. Okay. So they have knockout 22, knockout 23, and a pretty decent 24. And then expectations, we're seeing a marked slowdown of revenue and earnings growth. Okay. So the stock is potentially X growth. When you look at it, it's probably a phase 2 short. I think at this level, it's probably, entering a new short here might be a little bit dangerous in terms of timing. But I've been watching this stock now for a couple of months, and it really genuinely doesn't want to participate in the rally for whatever reason. Okay. There's sellers everywhere all over it. Okay. When you look at the bigger picture, revenues for this company in 2007 were $148 million. Okay. The forecast, the reported number in 2024, their fiscal year 24, was 9.6 billion. So they've 65x'd their revenue in 16 years. Okay. So if you're bullish on this stock now, you are coming in very, 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 very late to the party. Okay. There's obviously been a marked slowdown in revenue and EPS growth, and they've had a massive run as a company. Okay. We're seeing valuation compression. So it's currently on 20 times earnings and 3.3 times revenue. At its peak stock price, earlier this year, it was on 37 times earnings and 6 times revenue. Okay. So there's obviously a valuation compression here with the company going X growth. This is what EPS looks like versus the stock price. So, this paints a picture, right? Because EPS is going up until this year, and then it goes sideways a little bit. Okay. But the stock gets absolutely buried. Okay. It gets buried because the growth has slowed, not because EPS is still high. Okay. It's the growth has slowed. Okay. So this is what we talk about in the PTM video series, for example. Brick and mortar retail stocks that go X growth, they get hammered very, very quickly, and they get valuation compression because the story is basically now over. So it becomes like a normal stock. It loses the premium versus the sector. Okay. And this is revenue. So revenue, This is revenue forecast for 2025, 10.7 billion. The forecast hasn't gone up since 2023, right? So again, it's a slowdown in revenue growth, the growth rate, okay? And the stock gets hammered. From top to bottom, a 44% decrease. So from earlier this year to now, 44.5% in this market. So think about the underperformance of that versus Lulu. Versus NASDAQ. Versus the S&P, right? It's a significant underperformer, okay? And there's very good reasons for it. It's X growth. It's in the process of going X growth, okay? And if they continue to have a slowdown, which is very typical in these situations where retail brands, lose their edge. They lose their cool in fashion, right? They go X growth and they continue to decline in sales, right? They don't just have one hit or one slowdown in sales. It usually continues, right? So valuation compression, 44.5% move to the downside in 7 months. Okay, it's huge. Key levels that you can look at here: 280 level, 250 level. If it breaks that 250 level, I mean, look where this stock was trading before COVID. Okay, so before COVID, 2019, we're looking at low hundreds. Okay, like you could see something like that in this stock where it goes down to levels like this. So it just becomes like a normal retailer with no brand edge anymore. Okay, so what can you look at here as a setup? Well, a lot of our guys they've ridden it down already. They've taken profits and they've gone back in. So looking at the 290 strike in December, but collecting credits along the way. So trying to maybe collect your first credit in August. You know, you can buy the 290s at 25 here, maybe set up in ratio where you sell the 280s and try and get that credit. So you're agnostic in August and you try and get that credit. And then you can maybe pick another one up in September or October, but you don't want to overtrade it, right? So you want to try and pick up credits along the way that are at sensible levels. Try to even pick up credits into a sell-off. So, you know, if it's sold off, if you collected this credit in August, then in September it's sold off to 260, you know, maybe sell the 250s in September. Pick up another credit in September, then let the long run and see how far you can run it, right? So with that one, you know, I'll leave it with you guys. It's up to you guys to decide what structure is good for your portfolio. But the 290s in December are probably the long leg that you're most likely to look at. Okay, next one, Moderna. This company, guys, you know, you got to be very objective here. Obviously, I've got a view on vaccines, right? You know my view on vaccines. But being very objective, you know, just look at this table, okay? Again, what's in gray is reported. What's in white is forecast, right? This company in 2019 had $60 million of revenue, okay? The corruption in this stock is insane, right? So they obviously have a massive 2021 and 2022 for revenues, okay? And they have profit for the first time. As soon as they come out of a global pandemic, okay, they start making a loss again and massive amounts of revenue decline, right? And then for some reason, we are expected to believe that in 2025, they're going to get revenue growth again, but continue to not make a profit until 2027. It doesn't make much sense. It looks like a fantasy. Okay. So we know the past of the company. It's very much photographed as a bit of a corrupt, fraudulent entity. Okay. The only time they've had any success in the history of the company and made a profit was during the COVID so-called pandemic. Okay. There's now obviously massive safety concerns over mRNA technology. Excess deaths continue to occur across the world, and no one focuses on it post the mRNA vaccine treatment. They're now attempting to vaccinate livestock with mRNA, which stinks of desperation because now they're having difficulty selling it to humans, right? And don't forget the over purchasing of governments during COVID 2021 and 2022. This is how they got their numbers. Okay. There was massive over purchasing. So I believe the EU bought a ratio of 10-1 vaccines per citizen. Okay. For the EU. It's complete, there's complete corruption going on here, guys. So objectively, this thing is probably going to collapse at some point. Okay. They've got a current market cap of 46.5 billion. And if we're using 2024 revenue, they're on 11 times revenue. Okay. That's fantasy. That is a fantasy valuation. Okay. Because without another global pandemic, they're not even forecast to make a profit till 2027. Right. And the revenue numbers, I don't even see how they're going to get them. Right. So this one, guys, probably a big screaming short, but again, it's all about timing, right? So you've got to try and time these well. This thing had a 134% rally from the bottom of 2023 to the top, and is down from peak 30%. So it's had a 30% drawdown from peak. Okay. Plenty of my students are in it. They've ridden it down and they're going in for a second bite already. Okay. So most obvious strikes to be long for your puts, and calendar. You're probably going to be looking at the October 120s or the 115s in November, because you need to get a meaningful amount of contracts, right? So if you're running $100,000 portfolio, if you're going to get 8 contracts roughly of these guys, one or the other, and then collect some credits along the way, then that makes sense. Okay. So yeah, Lulu, Moderna, pretty good shorts in my opinion. Next one is a tail risk trade, which is slightly entertaining, and I think you're going to like this one because it's actually got a very high chance of payout. Yeah, and payout in a big way. Okay. The company, when you look at it objectively, is toast. It's fucked, right? The company literally doesn't work. The business doesn't work, and the balance sheet is a disaster. Okay. So it could actually go to zero by the end of this year. Okay. The market's probably pricing in a 1% chance of it happening this year. I reckon it's up to 20% chance. It's definitely over 10, but it's not over 20. A 20% chance that the company goes to zero by the end of this year. The stock goes to zero by the end of this year. Okay. That's big enough for a tail risk trade, because it doesn't have to go to zero for you to get paid a lot of money. It can still pay a lot of money if it goes down 30%, 40%, right? But if it goes down 100, you cash in. You make a fortune on this one, okay? So let's have a look at the balance sheet. What a disaster, guys, okay? They've got $3.6 billion in assets. That's made up of $3.2 billion of goodwill and other intangibles and $100 million of accounts receivable. And that's with the business not actually working, right? So they don't have any assets. And let's look at the business, because if the business doesn't work, goodwill and other intangibles are irrelevant. They have no value, right? So if the business doesn't work, these are a zero. And your balance sheet is, the asset side of your balance sheet is basically 600 million, okay? So the business itself, who knows about the backgrounds of Bumble? You should know about this one in the dating app market, right? If you've ever been on dating apps, like, you should know what the kind of angle that Bumble was supposed to have. So basically, like, Tinder is a hookup app, right? And like, men can approach women on Tinder, obviously, okay? But the founder of Bumble, who was at Tinder, left, set up Bumble, and the whole concept of it was that men cannot make the first move on the app to women. Women have to make the first move. So it's basically giving power back to women, like the female empowerment narrative, right? When it was all, pre-COVID and feminism was amazing and blah, 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 right? The female empowerment concept for this company failed miserably. Why? Because all the men just left the app. So what happened was, in the end, they had to capitulate, okay? So this stock was obviously down massive after IPO, okay? In May this year, after like all the men leaving the app, so women were basically just like shouting into a black hole on the app, right? They started allowing men to approach women on the app. Okay. So what does that mean? Well, first, it's an obvious admission that the entire original business model failed. Okay. So imagine if you're a shareholder on the IPO of this company, right? You've just been told that everything you invested in was a lie and doesn't work. Okay. Second, it now invalidates the entire reason why women were on the app in the first place. So if you're a female who was on the app before for that very reason, you're leaving. Okay. So now, for both women and men, there's no reason for either of them to be on the app, right? So you might as well just be on Tinder. It'll just become a hookup app, right? So Tinder is for hookups, and Hinge, these are match group brands, right? Tinder and Hinge is supposed to be for serious relationships, apparently. Okay. And there's plenty of other match brands that Bumble basically just can't compete with. So Bumble subscriptions are probably plummeting and going to continue to plummet. So goodwill and other intangibles is worthless. They don't have it. They don't have any intangibles, right? So the asset side of their balance sheet is not 3.6 billion. It's probably 3 billion. Sorry, 600 million, right? So we look at the liability side, 1.3 billion, just under. 628 million is long-term debt, and 400 in miscellaneous long-term liabilities. We don't even know what that is. Let's give them the benefit of the doubt on the asset side of the business, accounts receivables. People are going to pay their subscriptions from the end of 2023 to the end of 2024. So let's just say that's the case. Probably isn't, but let's say it is. Okay. If we strip out goodwill and other intangibles, because the business has basically failed. Yeah. You've got assets of 600, liabilities of 1.3. So the company net worth is basically just under negative 700 million. Okay. The current market cap is 1.7 billion, and its valuation is on 14 times forward earnings. Okay. And 1.5 times forward revenue. And it's a joke of a business. So I really think that there's a much higher chance than the market is pricing in that it could go to zero by the end of the year. This is the IPO here, which I believe is $43. In the 2 days after IPO, it traded up above $80, if I remember correctly. Yep. The stock's now $9.33. Okay, well, this is when I took the screenshot. So I think it was like 2 or 3 days ago. The stock had a rally this week and then got hammered again the next day. So it's volatile. I mean, this thing could if it had like a few days volatility to the downside, it could go below 8 within just a few days, right? So what would we be looking at? Probably you'd be looking at either the 8 strike in October for 40 cents, or you'd be looking at the January 6 strike, so way out the money, for 20 cents, okay? But very long dated. How would you go about this? If you assume a $100,000 trading account, $5,000 tail risk spend. So let's have a look at the October 8 strike puts. 40 cents, $5,000, it's 125 contracts, okay? Scenario 1, stock goes to $5. So it doesn't go to 0, it goes to $5. You make 32.5 grand, 650% return, okay? Scenario 2, stock goes to $2 by October. You make 70 grand, 1,400%. Scenario 3, stock actually goes to 0. You get a bit lucky and it goes to 0 before October. 95 grand on a 100 grand trading account. Amazing. The Jan 6 strike puts, if you want to give it a bit more time, $5,000 for a 20 cents contract, 250 contracts. Scenario 1, 45 grand. Stock goes to $4, 45 grand, 900% return. Scenario 2, stock goes to $2, 95 grand, 1,900% return. Scenario 3, stock goes to 0, 145 grand, 29 times your money. Obviously, your downside here is 5 grand, guys. So if you think you can handle a write-off of $5,000 in January, that's a great trade. So yeah, just wanted to feedback those shorts, guys, because in a market environment like this, people are going to forget that they need to have shorts in their portfolio. So again, don't lose your discipline to have shorts in your portfolio when the market goes up and everything's really bullish, everything feels amazing, and you've got longs that are working in your portfolio. You need shorts as well, okay? So obviously we want shorts that are working. So we've got different types. We've got ex-growth shorts. We've got corrupt and fraudulent shorts. And we've got tail risk shorts, companies going bankrupt, right? So I wanted to feed that back to you to get your brain thinking. Yeah, you can take again a photo of this screen because there's obviously other shorts out there that we haven't covered in the group. So take a picture of that screen if you want. And that's it, guys. I can take questions. And I'll unshare the screen. Yeah, you got any questions, guys? Just put them in the Q&A area. Happy to answer them.